Hey, Dr. Joe in the house. And I hope you're doing well on this Wednesday evening. Hold on, let me get my Instagram folks online. And I think they are online right now. So, another great session today. We're going to talk about money, cash flow, and how you can leverage cash flow on your real estate investment activities. So, I hope you had a great week. Let me just get my stuff together and so on. So essentially, what we're going to do is master the cash flow. One of the key to your success long term is to be able to have continuous cash flow on your rental properties. And there are different ways to get cash flow. Obviously, the obvious one, which is to increase income and reduce expenses. But there are also other strategies that you can do, and that's what I'm going to talk about today. 7 different strategies. Normally, I break my sessions into 6 parts, but today we're going to talk about 7 different strategies that you can do, and so on. So, but usual, before, if you have any questions, please enter your questions into the chat box, and I'll get to them in about 20 minutes from now. Anything to do with real estate investing, anything to do with real estate strategies, anything to do with cash flows, anything to do with deals, deal structuring, and things like that. Put them in the chat box, and I'll get to them very, very shortly. Likewise, if you want to book a one-on-one with me, where we can go a deep dive into anything to do with real estate investing, any deals that you're working on, any problems that you're facing, any challenges that you have, you can always book a one-on-one. Just go to my website, www.joeasamoah.com, www.joeasamoah.com, and then you can select the button called Ask Dr. Joe. So with that said and done, let's get down to business. Master the math. 7 cash flow moves that work in 2025. These are things that you can do today. You can implement this year, right now. This is not 10 years ago, 20 years ago, 20 years from now. This is today in 2025. So I suppose the question is, are you making money from your real estate investments, or are you just managing property? That's the issue. Sometimes it feels like we're just managing properties, but really making no money. And every investor, I think, loves to say, well, my profits are cash flowing. Okay. But in today's economic environment, when everything's going up, insurance is going up, premiums are going up, maintenance costs are going up, interest rates are going up and down, taxes are going up. All these things are going up usually. And therefore, yes, you may have been making cash flow a year ago, 2 years ago. Maybe you're not doing that now. So people think they're cash flowing when in reality they may not be. Okay, too many. Essentially, what it means is that we're managing homes, but not really managing our businesses. So what I'm trying to do today is to sort of take the guess out of this, and take the gut feeling out of this, and get down to some basics. Understand the numbers inside and out, mastering the math of cash flow, which is really what we're all trying to do. And the key is that cash flow is not necessarily a mystery; it's predictable. There are 7 critical elements that we're going to discuss today that will go to that in more detail. So again, we're breaking it into 7 parts, and the goal is to hopefully help you make more cash flow on your properties. And these lessons I'm going to discuss today, as usual, it's from my experience doing this 35 years, and also speaking to other investors and learning from them. I love speaking to others. I love, doing these sessions because it forces me to do research. It forces me to network, and also it forces me to get my thoughts together. So that's what we're going to do here today, break into 7 different parts. Let's get to it. So number 1, the power of pricing, income, I suppose. And the question is, are you leaving rent on the table, or are you driving tenants away? Are you leaving money on the table, or are you driving prospective tenants away? So, well, finding the right rent price, obviously, is going to be the key. It's almost like walking a financial tightrope. If you set it too low, you could lose money every month, and also you could be leaving money on the table, as they say. If you set it too high, then your property may sit there vacant while your expenses keep rolling in. So it's a tightrope. The key is to know your market better than anyone else. Know your market better than anyone else, and to price strategically, not necessarily emotionally. Okay, successful landlords, we don't guess at the rents. We analyze comparables. We monitor demand patterns. We assess what's affordable for tenants in real time. And many of us use creative strategies to increase perceived value, adding small upgrades to just that could be used to justify a higher rent without major renovation cost. What I mean by that, for example, you can add things like, I know for a Section 8, which is obviously what I'm a proponent of, is you need to understand how the local housing authorities determine what rents you should get. Is it zip code based? And so therefore, one part of town will get a different rent than another part of town. That's something you need to know. And the other thing is, if it's a gray area in terms of what you can get for your rent, then you need to understand what quote unquote brownie points you may get by having certain things, certain amenities. So, for instance, you may, if you have a washer dryer, for example, that could allow you to charge slightly more rent. If you have certain appliances, that could allow you to get more rent. If you have off-street parking, that can allow you to get more rent. So there's certain amenities that your local housing authority may value more than others. If you have granite countertops, for example, that may not be, get you any more rent because they don't do it. Having more bedrooms will. Okay, so now you're going from say a 4 to a 5, or from a 5 to a 6. So adding more bedrooms will get you more rent for the same asset. So you can be strategic on how you prepare your properties, and in order to maximize the incomes that's possible. For me, as you know, I typically buy 3-bedroom homes. And then I add extra bedrooms, whether it's 1, 2, or 3 more bedrooms, to turn them into 4, 5, and 6-bedroom homes. And because of that, I'm able to get more rent. So again, you can be strategic about it. You can be emotional about it. I think that you can be strategic about it and tactful about it in terms of how you can maximize the rent. Okay. So on the flip side, some landlords have what I call rent stagnation. They keep their rents flat for many, many years with a fear of turnover. And that's a good fear. But if prices have gone up, maybe it's appropriate that you increase the rents for your property, because stagnation of your rent erodes profitability. And if you're in a multi-family environment, it can diminish property values. Okay, so proactive investors like you and I, hopefully, we evaluate rents regularly, either quarterly, annually, 6-monthly. We factor in things like inflation, taxes, and utility changes, and then we price our rents accordingly. We don't just chase higher rents for the sake of it. We want to target and provide the right rent, the one that balances top line income with long-term tenant retention. Okay, so that's number one. So some action items: review your current rents on a regular basis and do some market comparables. Implement modest value add to increase your rent: paint, flooring, smart thermostats, etc. And track vacancy rates. Okay, so that's number one. Let's keep going to number two. And we talked about income. Now let's talk about the expense side, the expense equation. And the question is, are you managing your costs, or are they managing you? Are you managing your costs, the expense side, or are they managing you? Cash flow killers don't just come from empty units. They come from lots of other ways, invisible sometimes, invisible leaks in your expense structure. Many landlords focus obviously on the rent side, rent collection, or maximize income, but they neglect the other half of the equation, which is operating costs. Okay, the difference between an investor barely breaking even and one achieving double-digit returns, it can really, the root of it could be expense control. That's the side which I've zeroed in on. Okay. I put things in place to minimize my expenses. And the biggest expense is turnover costs, which we'll talk about later on. But if you can manage your expenses, then you can make more profits from the same rent. And in fact, you may not even need to increase the rent because you reduce your expenses. Okay, so it's all about expense control. So experienced investors like you and I know that expense management is not just about cutting corners, but it's about maximizing efficiency. For single family homeowners, as I said before, the key is going to be reducing things like turnover and vacancy costs. Other things you can do is to negotiate insurance policies, which is what I've been doing, trying to reduce my insurance costs. For your maintenance, you can maybe bid out to vendors. You can, there are things that you can do to, to reduce expenses. The big ones, obviously, your financing, your taxes, your insurance, the maintenance cost, and you can negotiate with your suppliers, with your vendors, and hopefully that will, help you in reducing expenses. But the biggest expense, believe me, by far, is turnover. If you can control that, if you can manage that, you're going to do quite well. If you don't manage that, it's going to be a disaster, especially on the single family side. So ignoring maintenance or hiring unqualified contractors, you may think you're saving money, but in the end, it could cost you a lot more money because they just didn't do it right. You got to bring somebody else back in again to to do it properly. And so the goal isn't to spend less, it's to spend smarter. Okay, not spend less, but it's to spend smarter. The most successful investors build a culture of financial discipline. Every invoice, every quote, every recurring bill gets audited for efficiency and necessity. So what are some of the action items? Conduct an annual expense audit for each property, track maintenance, utilities, and management fees, and also establish some monies set aside for a rainy day so that way if you have an unexpected expense, you can avoid panicking and you can take care of it strategically. That's number 2. Let's keep going. Number 3, financing. Oh, that's a big expense. It's financing. And the question is, are you using debt as a tool or as a trap? Are you using debt as a tool or a trap? Leverage is one of the real estate's greatest gifts. It can allow you to fast track and grow your portfolio very fast. But also it's a double-edged sword. It can take you down. So used strategically, it can accelerate wealth building and free up capital for growth. You can use a burst strategy. However, misused, it can strangle cash flow and destroy portfolios. The most successful landlords in 2025 aren't necessarily debt-free. They're debt smart. We understand debt service coverage ratios, DSCR, loan to value terms, and we make decisions accordingly. We try to avoid the trap of quote unquote refinance addiction, constantly pulling out equity for short-term liquidity and while increasing long-term obligations. Refinances, they're not cheap, they're not free. Many times they just add more to your principal balance. And if you're not careful, it could suffocate your cash flow. You're adding more and more debt. And if something happens, you can't, you have a shortfall in income, then that debt, or you can't pay your debt, it could take you down. And that's what happens to a lot of times, especially for flippers. They buy a property, rehab it, take on more debt with the goal that they can sell the property or refinance later on. But the market shifts on them and they can't sell at the prices that they want. And now this debt is difficult to service and it can take them down. So, so be strategic about debt, have some reserves, understand the DSCR ratios and what works, what doesn't work, and track all your loans accordingly. Okay, so kind of halfway through, but let's talk about, again, if you got some questions, please put them in the chat box. I'll get to them shortly. Anything to do real estate investing, pull them down there. And if you want to book a one-on-one with me, You go to my website, www.joeasimo.com, www.joeasimo.com. I'll be more than happy to schedule a time with you at that point. Okay, let's keep going. Number 4, maintenance and upgrades. Maintenance and upgrades. That's another an issue in terms of affecting your cash flow. And the question is, are you investing in value or just spending money? Are you investing in value or are you just spending money? In terms of maintenance and upgrade, every investor faces the same challenge. Okay, how to maintain properties without draining profits? How to maintain properties without draining profits? I mean, sometimes things go wrong in a house. You got to do what you got to do. You got to fix it. The solution lies in distinguishing between maintenance, which is really preserving the value of your asset, and improvements, which is creating value. Okay, so the best investors see maintenance as proactive asset management and not necessarily reactive spending. Neglecting small repairs today almost always leads to bigger and more expensive problems tomorrow. Sometimes just nip it in the bud, take care of it, and so on. For example, a minor roof leak can result in structural damage that can cost 10 times more to fix. I had a real scenario where we had a leak in one of our refrigerator water lines, and the tenant told me about it. I was slow to respond, and next thing you know, it caused more damage. Water came down to the ceiling, and then we had to replace the ceiling. Okay, so yes, if you have leaks, especially, or sometimes minor problems, it's just cheaper to take care of it immediately rather than trying to drag it out and so on. So savvy landlords plan for, for preventative maintenance schedules, things like HVAC services, maybe twice a year, annual plumbing checks, and seasonal inspections. Upgrades, meanwhile, should be evaluated on an ROI basis. Okay, so if you're going to improve the value of the house, then it's going to be you have to decide whether you'll get a return on that investment. So the best landlords align upgrades with market positioning, focus on what their tenants value most. What's in it for the tenant? What do they value? And that way you can possibly increase the rents for the improvements that you've done. Finally, documentation is key. Keep digital records of repairs and maintenance for tax purposes, also for refinancing purposes. Lenders and buyers reward properties that demonstrate systemic care and operational transparency. Okay, so let's keep going to number 5, tenant quality. This is a good one. That can definitely affect your cash flow, is the quality of your tenants. The question is, are you renting for stability or for speed? Are you renting for stability or speed? As I mentioned earlier on, vacancy anxiety is every landlord's nightmare. Okay, the place is empty, you still got bills to pay, your mortgages due, you still got to pay insurance, taxes, and so forth, and the place is empty. However, renting out fast, especially to the wrong tenant, can be far more expensive. Sometimes it's better to have a place empty than have the wrong person in your house. High quality tenants are the foundations of stable cash flow. They pay on time, take care of the property, renew leases, stay a long time, and they're just better people for your sanity, having high quality tenants. On the flip side, poor quality tenants, by contrast, they can destroy months of income in a single eviction. They can trash your house. They can give you mayhem, drama, problems. It's not worth it. Been there, done that. Experienced investors have learned that the most important part of the property management process, in my opinion, is tenant selection. So what do? We use thorough screening systems that go beyond just your typical mundane credit score. We do other things like verify income. We talk to landlords, check on their rental history, and I even go to their people's homes just to see how they keep their home. So also we keep clear communications channels, especially up front. Before they move in, we set expectations. We tell them what we expect from them, and also what they can expect from us. The goal there is to set the tone for a professional, respectful landlord-tenant relationship. The best landlords go one step further. They treat tenants like customers. Customers, by by being responsive, offering incentives to stay longer. And because the bottom line is that a turnover is so expensive, it's not funny. It can cost you 2, 3, 4 months lost income after the dust is settled. You got to paint the place again, you got to clean it again, you got to advertise again, you got to screen, you got to select, you got to go through all this whole drama. And after you add it all up, it's going to cost you 2, 3, 4 times lost income. Okay, so that's why I focus heavily on tenant satisfaction, because if I have satisfied tenants, they tend to stay longer. Number 6, operational systems. And the question is, are you managing properties or running a portfolio? Are you managing properties or are you running a portfolio? Landlords typically manage chaos. Investors, we manage systems. You need to have systems in place. The difference is structure. And the most successful landlords treat their operations like a business with processes, automation, and measurable performance indicators. I do, maybe I'll do another session on that, on the performance indicators I use for my business. Many small investors lose money because they rely on memory, paper records, or emotional-based decisions. Those who succeed, on the other hand, we embrace technology, property management software for rent collection, automated maintenance tickets, and also inspection checklists and performance dashboards. I've hired this person from India, putting together automating all of my systems using AI. Use some of these tools like ChatGPT, Anthropic, Claude, and also these. What's the other one that he uses? Perplexity, I think that is. To create these performance dashboards. That's what we do. With these systems, that frees up my time to make decisions based on data, as opposed to just fighting fires and so on. So, well-run systems, can also improve accountability. Operational excellence doesn't just happen by accident; it's engineered. Investors who invest in systems create predictability, consistency, and scale. And finally, number 7, the mindset shift. The mindset, I think that's the key also for your cash flow. And the question is, are you guessing or calculating your way to wealth? Are you guessing or are you calculating your way to wealth? Numbers tell the truth, even when you don't want to hear it. Okay. The greatest investors think in terms of outcomes, not emotions. They make decisions based on data, not desperation. Those who succeed understand that mastery starts with mindset. You must see your portfolio as a financial engine, not a collection of homes. Investors who avoid numbers often find themselves surprised by tax bills, repair costs, or even negative cash flow. Meanwhile, those who review their metrics weekly, quarterly, monthly make small strategic adjustments that compound, I suppose, into massive wins. Okay, they view every challenge, whether it be bad tenants, raising interest rates, new regulations, as solvable through numbers, not through noise. The top 1% and 2% in 2025 are analytical, disciplined, and proactive. They know that financial mastery isn't glamorous. It's consistent, deliberate, and data-driven. And that's exactly what they do and why they win. So in conclusion, the investors who master the math will own the market. The investors who master the math will own the market, in my opinion. Real estate isn't a game of luck. It's a game of leverage, discipline, and numbers. The investors who understand their math hold the power to adapt, to pivot, and also to thrive in any economy. Those who don't will find them outpaced by those who do. Every landlord who has scaled successfully shares the same habit. They treat their rental business like a living, breathing enterprise. They forecast, track, and analyze every variable that impacts their profitability. They know where every dollar goes. They make sure that every dollar comes back with friends. And the truth is, the market will always shift, it will always change. Rates will rise and rates will fall, costs will change, and trends will evolve. But the precision beats panic every time. If you learn to master the math, You'll never again fear uncertainty. In fact, you'll profit from it. So, my friends, that is it for the education part. 7:30, and again, we're gonna go down to Q&A. If you got some questions, please put in the chat box. Anything to the real estate, put in there. I'll try to answer them in a couple of minutes. As usual, if you got to shoot me an email, you can email me at joe@joeasimo.com, joe@joeasimo.com. And if you want to book a one-on-one with me, by all means, book a one-on-one. Go to my website, www.joeasimo.com. Okay, that's it. So let's get down to business. Let's get down to the Q&A and see what we can do. Let's have a look. First one, Dow2. Hey, Dow2, hope you're doing well in sunny Phoenix. I hope it's sunny anyway. Damian Lloyd. Hi, my brother Joe. This is Damian from the Meet and Lease a couple of weeks ago. Oh, hey, hey, Damian, how you doing, man? Yeah, I met Damian at the Meet and Lease. This is an event held by the Washington, D.C. Housing Authority, where landlords can connect with tenants who are looking. I'm not too sure. I haven't been there for a couple of times. I just helped one of my students. We finalized, Damian, for your information. I think when I met you last time, we're looking to find a tenant for the 6-bedroom. We were able to close on that on Sunday. We did a home visit and gave it to the family. So that's very, very nice. So this stuff does work. I hope you're doing well. Nestor, when a person receives a Section 8 voucher, is there a time frame in which they must find a place? Does the voucher expire? When a person receives a Section 8 voucher, is there a time frame in which they must find a place? And does the voucher expire? The answers to the questions are yes and yes. Someone is given a voucher. Usually what happens is that either through they want to move, or they're moving into, or they're given the voucher for the first time. The voucher doesn't go on forever. It's not in perpetuity. I think that's what in perpetuity. Anyway, it has an expiration date, and so typically it's 3 months. And so if you're given a voucher, let's say in January, you usually have up until the end of March to find a place to use it. If you don't use it, i.e., you don't find a place for whatever reason, you can't find something, or no landlord wants to rent to you, or whatever the reason, then in most jurisdictions you can request an extension. So, and in Washington, D.C., they extended for another 3 more months, so a total of 6 months. So it gives you time to go find something. You got 6 months to find something. If you don't find something during that time, then your voucher expires, which means that it's just a piece of paper. And so it means that you either have to stay where you are, you can't move because your voucher's expired, or you can go back to the housing authority to see if they'll extend it again, or you have to wait another 6 more months and then try it again. So there is an expiration date for your voucher, and there is a time frame where it's valid for. Depending on the jurisdiction that you're in, it could be 3 months, 6 months, 12 months. Okay. The reason why I asked the previous question is because the potential tenant called me about my rental, and they always seem to be in a hurry to find a place. They also looking at 10 other properties. Okay. Yeah. So yeah, because they're in a rush because they may be nearing towards the end of their voucher valid. Okay, so it's near expiration, so they're getting desperate because if they don't find anything, they may not be able to move again, or they may lose their voucher. Okay, so they're in. Some of them are desperate, and they'll take anything. And that's not always good. You don't always want to rent to a desperate tenant. At least I don't, anyway. Now, why they're desperate, that may be legit. But it's just like you being a desperate landlord, where your mortgage is due, your expenses are piling up, and you got negative cash flow, you got no money, and all you see is bills, mortgages due, and so on. And then you get some, let's just say, marginal tenant applies at your property, and now you kind of getting desperate. So you may, well, you know, they were evicted last week, but yeah, they seem like good people. Oh well, you know, da 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 da. And so you may lower your criteria, your standards, and take them on because you're desperate. Whenever you're desperate as a landlord, it's not a good thing. You know, you may get some short-term reprieve, but my experience is that you're going to have long-term pain. It's just a disaster waiting to happen, and so on. So they're in a hurry, and which means that they'll take anything. And they may take your place, Nesta, not because they like your place, but they take your place because they're desperate and they think they're losing their voucher. So what will happen is that if they're desperate, they'll take your place. Once they move in, they realize that, hey, this place is not always cracked up to be. I don't particularly like the neighborhood. I don't particularly like the house. I don't particularly like the landlord. And so now their short-term pain is now gone. So now they have got time to go find a place that they really want. And so what's going to happen is that they may not stay at your house very long. That's what typically happens. Not typically. That's what sometimes happens when you have desperate tenants, because they have to take something. They'll take your property, but it may not be what they really want. And once they get settled, once the cloud over their head, the dark cloud has gone away, when they can sort of relax a little bit, then they'll start realizing that this is not the place for me. And then they start looking for other places. And then you're likely going to have a turnover or a vacancy at some point. So they're also looking at 10 other properties. Yeah, they're desperate. They're looking at anything. And so as far as they're concerned, let's just throw our hat into all these rings and hopefully something will come through and they'll take the first thing that comes. So again, I have sympathy for people in situations like that, but you know, you're running a business and you have to make business decisions based on what makes the most sense for you. Okay, I have a deep dive session with you next Wednesday. We can discuss more. Looking forward to it. Yeah, look forward to it, Nesta. And yeah, so yeah, look forward to it, and we can have a good conversation, I'm sure. Okay, Dow 2. How are you negotiating your insurances? Phoenix has no natural disasters. So if I was the actuaries, I would say Phoenix should have the lowest cost in the nation, but my insurance goes up every year. Well, my insurance goes up every year. How do I negotiate it? You can shop around. Different mortgage. There are different insurance agents. There are third-party insurance companies. You know, you can. You know, there are mortgage brokers which you can contact. You explain the situation, and they'll shop around to find different carriers that can offer you competitive rates. So that's what I've done. You know, I contacted this company, national company, and they're licensed in Washington D.C. area, Maryland, Virginia, and they have you know, carriers that insure in our areas. So their job is to shop around. A long time ago, I used to rent. A lot of my policy was with Allstate, and it's just one carrier, and their rates were pretty good. But for whatever reason, Allstate, in its wisdom, decided they don't want to rent properties in Washington D.C. So they pulled out. So that forced me to go find other alternatives. Because obviously, if you've got mortgages on the houses, you got to have insurance. Because if you don't have insurance, the insurance company, the mortgage company, will get their emergency insurance, which is usually double or triple what it really costs. So I shopped around, did some research. I found this you know, insurance broker, and gave him my property list, and then they went looking, and I've got some really good, you know, pretty good prices. So that's how I did my shopping around, or negotiations, you can call it. You can contact several different insurance brokers and have them provide you with quotes, and then you go to the carrier that makes the most sense. But yeah, insurance keeps on going up. I doubt insurance is going to go down. Natural disasters, you know, which are hitting these insurance carriers, I suppose a lot of them are losing money. So they have to somehow offset those losses by increasing premiums, I think. Okay, in perpetuity. Yeah, perpetuity. Perpetuity. Is that it? Perpetuity? On and on and on and on. That's what I mean. Perpetuity. I know what it is. I know what it is, but I just can't pronounce it. Perpetuity. There you go. I think I'm right. But in anyway, you know what I'm saying. It goes on and on and on forever and ever and ever. Amen. I'm curious if you had experiences using projected rent to help qualify for financing on an owner-occupied multi-unit property, essentially a house hack setup. Okay, let's have a look. You got a second part to this. Specifically, I have someone with a 2-bedroom voucher who could move into one of the units. Okay. Let's have a look. Let's go back to your question. I'm curious if you've had experience using projected rent to help qualify for financing on an owner-occupied multi-unit, essentially a house. Like, yeah, okay, I got it. So what you're saying, Katie, is you got a property, multi-family, and you are looking for financing, and so as part of the financing or refinance, then the the financing company, they typically do an appraisal, and they also do a rent analysis and of your property to make sure that the rents that they can expect is in fact will take care of the debt, the mortgage that you're trying to go with. So typically an appraiser will come in, and then they'll do an appraisal of the value, and also they do a market analysis of the rents. What I do in situations like that, Katie, is I provide them with my Section 8 contracts and my because typically around here anyway, especially what I do, I buy 3 bedrooms, 4 bed, and turn them to 4, 5, and 6. So I'm able to get higher rents than similar properties that haven't got the same bedroom count. So I have to educate the appraiser that, hey, yeah, I know that houses on this block are $3,000 or $4,000, but they're 3 bedrooms, and I've got a 5-bedroom, and my rents are 5,000, which is higher than what other people are getting. So I have to educate them on why I'm getting more. Otherwise, they'll default to whatever it is other people are for that property in that area. So I have to provide supporting documents for the numbers that I'm looking for, and I suggest that you do that. So if you're doing a house hack whereby you're gonna rent some of the space out and you're gonna live somewhere, yes, you should use projected rents, and you can do a market analysis. But typically, mortgage companies, at least in my experience, it's much easier to refinance when you have a contract, when you have actual rents, not projected rents, because then you can show them a contract. You can demonstrate that this property is generating income. So I would suggest to you that yes, you should refinance, you should finance, but also you may want to wait until you've got some income to support with real numbers to show for it. But yeah, you can try and get away with projected. Well, this property should generate this income, which when added to mine, it may work. But I would say it may be easier for you to live there, get a tenant in there, and then apply for financing, because now you have your personal income, and then you have proof that you have rental income and the amount of rental income that you're collecting. It just makes it easier to qualify for a loan if you got supporting documents to prove that you have this income coming in. Okay, so look, your third part. Okay, hold on. Specific, I have someone with a 2-bedroom voucher who could move into the unit. Okay, yeah. So if you got 2-bedroom, you want to go to your housing authority, and or if you know what you're going to charge for the rent, then you can try and see if they'll accept that. But many times they may not, unless there's actual physical contract that you have a lease in place. But it's worth a try. Have you seen situations where voucher, lease promise, or similar lease promise? I'm not sure what that is. Whereas lease promise or similar agreement was used as part of the projected rental income during the underwriting or loan structuring? A promise? No, I usually provide them with a lease, a completed lease. Yeah, as opposed to some market assessments. So yeah, I've had more success with actuals as opposed to projected. But underwriters are funny people. So you can try, and see if they'll accept your projected numbers. But depending on the underwriter, I suppose it may or may not work. I prefer actuals. That way I can show them, I can prove to them that this is what I'm making and or collecting in rent. And then in your case, that plus your income, hopefully should qualify for the mortgage that you're getting. Okay, so again, I'm going to wrap it up in a couple of minutes. If you got any questions, please put them in the chat box. Otherwise, yeah, I'll wrap it up for the day. But hopefully today's session was good. I hope you learned quite a bit from it about cash flow, different things that you can do to increase cash flow of your properties in 2025. Again, I'm going to recap. Pricing, make sure that you price accordingly in terms of income side. Expenses, make sure that you manage costs. And 3, financing. That's a big expense. So you want to, if you can reduce your financing costs, getting refinancing to a lower interest rate, or maybe reduce 30 years into 15 years or whatever, you can do that. You can save quite a bit of money in interest and so on. Maintenance and upgrades. You can save a lot of money by taking care of maintenance. Tenant quality. Make sure you take the time to select quality tenants. Better tenants, the less hassle. Operational system, put systems in place to manage operations. And, and then finally the mindset. Have the right attitude, have the, goals, and you should be fine. So my friends, I think that's it. So let's have a look. And yes, thank you, Carlis. So my friends, have yourself a wonderful evening, and I'll see you next Wednesday. I'm, as I said last time, off to the Caribbean in a couple of weeks for a couple of weeks vacation, and then off to Atlanta, where I'll be one of the keynote speakers at a real estate conference. I'll give you more details on that next week. Have yourself a wonderful night. Take care. Bye for now.